Welcome to Trade the Trend, a weekly video about where the stock market is heading. This video is going to focus on the SP 500. We're going to have a look at the ASX 200 as well as gold, copper and uranium in a separate video. I'll leave a link for that in the description section below. And in this video, I'm also going to have a look at a couple of potential danger points. So make sure you stick around for that. As always, general commentary doesn't take your personal situation into account. All of that said, let's get into our first chart. So kicking off with the S&P 500. So it seems that we're getting the consolidation that we've been talking about the potential of over the last couple of weeks. And this is why I've been hesitant over these last couple of weeks to add to long positions, because of the possibility of this pullback creeping in. And I think the question here is what scale of consolidation are we going to get? So I think the best case scenario would be something that sort of maybe travels sideways for a couple of weeks, several weeks, and then starts to break higher again. I think that would be our best case scenario, something shallow, just sort of works away a bit of time, lets these moving averages catch up. And so that's certainly one of the possibilities. But I think there's also a possibility that something deeper develops over the near term. And so what we can do, we can put some Fibonacci retracements on. So let's use this May low as the starting point and use the recent high. When you put the Fibonacci's on, you can see the Fibonacci range below the market, and it gives targets or potential pullback, not so much targets, but a potential pullback area back towards 4,400, maybe a bit below. That's right where the right around that region the moving averages currently are. I think the thing we've got to remember is that this market has since May. This market's put on 14%. So that's a sizable rally without any substantial pullbacks or consolidations. We really only had these like 2%, 2.5% pullbacks along the way. So the thing with every rally is that every rally needs to be checked by a period of consolidation. And the thing which you've heard me talking about over recent weeks is that this market, it's stretched above the moving averages. So I got the 50 and the 100-day moving averages. And the thing with these moving averages is that they act a bit like gravity. So a market can run away from these moving averages for a while, but at some point, they end up being pulled back down and reconnecting with those averages. So I think this 4,400 area, this would be quite proportional given the extent the market's run. Maybe we get the shallow sideways consolidation, but just keeping in mind being prepared, being mentally prepared, also being prepared in the case of maybe not wanting to have huge amounts of leverage, that larger pullbacks are certainly a possibility. I think that overall, this upward trend remains in place. And this is a key statement I want to make. I think overall, this upward trend remains in place. So I'm looking to hold positions. Talking about pullbacks, but talking about pullbacks doesn't mean looking to sell everything and get out and maybe buy back in later on. There are pullbacks and there are change in trends. Pullbacks can be ridden through with appropriate risk management, depending on the time frame that you're operating in. For me, it's medium term. I sit through moderate corrections where that's reasonable to do so. And over the last couple of weeks, I've been talking about it not being an asymmetric entry point in recent times. But what happens now, if we do get a consolidation, maybe that does create an asymmetric entry base for a new rally to really push on from. So let's just watch this price action over the next few weeks, see if this market continues to consolidate, what that happens to look like. Now, jumping over and having a look at the Nasdaq, and very similar story. We've got this big unchecked rally over the last few months. Again, stretched above the moving averages, and so it's only normal to get a bit of consolidation coming in. The other point to be aware of is there is some divergence with the S&P 500. So the S&P 500 recently made a new high. I think it was last week, made a new high, but the Nasdaq didn't confirm it. It's now pulled back. So it's not a huge big deal. It's not like some of the divergence we see, which might form over weeks. It's just a short-term thing, but it's just another sign that this rally could be done for now, and there is some work that needs to be done. Now, an indicator which I want to have a look at, and we did look at this last week, I'm looking at, and down the bottom, this is it down the bottom. This is the percentage of SP 500 stocks above their 50-day moving average. And there's been more development in this over the last week, so it's interesting to take another look at. So how this works. Of this red line above, that marks the 90% mark. That's when 90% of stocks are above their moving average. And we recently got to there. Well, we actually was just shy of there. It was 89.4% or something like that. So I would say effectively 90% of stocks were above their 50-day moving average. Now, I want to have a look at what's happened at past instances. As you can see, this has now started to clearly roll over. And once it peaks, what's interesting is that once this percentage gets to 90% and peaks and starts to roll over, it typically doesn't quickly bounce back to the 90% level. I'm going to show you that in a moment. It's a bit like once the air starts coming out, it tends to keep coming out for at least several weeks, if not longer. Now, big important thing to note here, that doesn't necessarily mean that you get a big sell-off. Like people will look at this period in August last year where it peaked, came back, and we got a sizable sell-off. Doesn't mean that at all. It could happen, but that's not necessarily the outcome. Often it just works out to be a pause, like we saw in December, and then the market regathers steam, I should say. So let's just go through and have a look. So bearing in mind, this is where we are now. We've had the market peaked, the indicator peaked in late July, and the market's just starting to turn lower now. So just going back, looking at some of these previous times. So here's another one. This was back in April 21. Peaked. See, it continues to come off for several weeks. Market just pauses. It goes sideways for several weeks. There is some selling, but it's nothing significant. And then the upward trend regains its momentum. Something similar happened in June 2020. Indicator peaked, came back over several weeks. Market paused. There was a pullback, but again, it's nothing significant. Then the upward trend gained momentum. This indicator is more useful for picking bottoms than it is for tops, from my reading of the indicator, at least anyway. Let's just compress this a bit more, get some more data. Again, another instance from 2019, peaked, pulled back for several weeks. Market on this occasion, again, just a bit of sideways, and then it continued upward. So this is it's a similar trend as we go through all these examples. The sideways can last for a while, so we don't know. It doesn't tell us how long. You can see it's not leading to crashes and giant sell-offs. Doesn't mean it can't, but that typically hasn't been what has happened. And I'm going back over the last 12 years, as far back as I've got data. And you can see this same pattern where it rolls over, it doesn't come straight back, to where it was. The market isn't falling away. It does typically lead to sideways and mild pullbacks on most of these occasions. So you can go through this video a little bit slower, pause it, have a look for yourself, call up the indicator on your own, do your own analysis on it. That's my take on it. I think that's why I'm favouring the market pauses. Pause could last for more than a few days, and maybe we're looking at several weeks. So just something to keep in mind, keep an eye on. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Tells YouTube that people are engaging and YouTube shows other people. That helps me a lot, so please do that. Hit that subscribe button if you haven't already as well. Now, let's have a look just at a couple of risk points for the market, which I just want to go through with you briefly now. First one is the US 10-year yield, which is breaking higher. So this has been, I spoke about this, I think it was 2 or 3 weeks ago. So 2 or 3 weeks ago, we started to get a breakup out of this It's a bit of a flagging sort of formation where you get a big rise, a big rally. In this case, it was a big rise in yields. You get the downward consolidation. You can get these blue verging trend lines. That's you'd call it a flagging formation where you get the rally, you get the flag, and then you get the rally. That's classic technical analysis. And we got that breakout in July. Didn't go too far. Came back within the this top boundary of the pattern. I thought, look, maybe this pattern isn't going to play out. Maybe we're going to come back into the range, and this isn't going to be a big deal. But it has regained momentum. Just put some moving averages on as well. It came back to the moving averages, right back to that 50-day moving average, and has rebounded off there. It's back at the highest yield since November. So this is a potential pressure point for the stock market, which could again lead to that consolidation we've been speaking about. So keep an eye on what goes on with yields. I think this is shaping up that it looks like this high from October 22 is going to get tested, and we could see a new high in yield. So it's tighter liquidity, perhaps that leads to consolidation scenario. Having a look at the US dollar, another thing which could lead to this consolidation I've been talking about. Now, this is interesting. I've got a couple of lines, a couple of support bands here. So this first one is it's a longer term one, goes back to 2015. Just compress this for a moment just to show you where this one goes. And actually, I'm going to quickly put this on a weekly to show you this one because it goes back so far. So yeah, back here to 2015, this has been an area of significance. And jumping back to our daily, and then I've got this shorter term support in here, which just marked the lower boundary of a trading range the dollar had found itself in since February. Now, what was interesting is we actually got a break. We got a downward break from this multi-month trading range in July. Now, this should have attracted follow-through selling. That's typically what you get from a break of a trading range and a break of support. That's not what happened. There was no follow-through selling. Market quickly got back within the range and now rallied back towards these moving averages. Now, what's interesting to keep an eye on here is this is, as it stands, a false break. And when the obvious path of least resistance, in this case to the downside, doesn't occur, it opens up the possibility that the path of least resistance is actually swinging to the side. So maybe we're going to go through a period where we're going to see this dollar continue to rally over the next, I don't know how long. It could be a relatively short-term thing where it goes for several weeks or a month or two. I don't have a strong medium to longer-term view on this dollar. I'm just sort of playing it as price action occurs. But we want to keep an eye on this because stronger dollar could mean a risk-off environment where some of the theme does come out of equities, at least the near term. So things to keep an eye on. Why? Look, it's been conservatively long for months now. Remains the case, but I continue to hold on to these long positions because at the moment there's no reason to exit them other than potentially seeing off what I think could be a modest pullback. But it could go on for more than a week or two. So look, hopefully that's been interesting. Hopefully it gives you a few things to think about, and I look forward to coming back and talking to you next week. Till then, bye for now.